2021. We are beginning our meeting at 1:25. We apologize for the delay as we had technical difficulties getting us started. So thank you all for your patience. We are in the Chesapeake building on Baldridge Street in Leonardtown. Board members present today are myself, Rebecca Bridget, County Administrator, Jeanette Cudmore, CFO, Lieutenant Moses and Lieutenant Safford, or Sheriff's Office representatives, are joining us via conference call. Good afternoon, gentlemen.
Good afternoon. Good afternoon, Dr. Bridget.
Thank you. And Catherine Pratson, our Plan Administrator, is also in attendance as well. And thank you, Tracy, for filling in for Sheila today. And thank you, Amy, our videographer, who's assisting us as well. And so we will jump right in. We have a quorum for today, so we'll jump into 2A, which is under roll call for approval of today's agenda. If you take a minute to review, I'll entertain a motion to approve.
I'll make a motion to approve the agenda for today's date, November 18th.
Thank you. We have a motion on the floor to approve today's agenda. Do we have a second?
I'll second it.
Thank you. We have a first and second to approve today's agenda. All in favor?
Aye.
Aye. Aye.
Any opposed? Motion carries. Thank you. And item 2B is approval of the minutes for October 28th, 2021. If you take a minute to review those, and then I'll entertain a motion to approve.
Sean Moses will move to approve the short meeting minutes for October 28th, 2021, Dr. Bridget.
Thank you very much. We have a motion on the floor. Do we have a second?
Clay Safford will second it.
We have a motion and a second. Any discussion? All those in favor?
Aye.
Any
Aye.
opposed? Motion carries. Thank you very much. Under new business is 3A, and we have Pat Wing from Marquette Associates joining us today. And again, apologize for our delay. Appreciate your attendance today, and we'll turn it over to you.
All right, great. Thank you, Dr. Bridget, and good afternoon, everyone, and good afternoon, Lieutenant Safford and Lieutenant Moses. So we'll begin today with a review of the third quarter performance report. For those of you in attendance, that is the thicker book on the top of your packet. And if you would all please flip behind Exhibit 2. So grab Exhibit 2, flip that over. Exhibit 1 is just an update on our farm Marquette. Nothing too newsworthy in there. So where I'd like to begin again is in the market environment, and specifically on page number 12. And just talk about a little bit about what happened in markets to provide some context for how and why the pension fund performed the way it did during the quarter. So if I can draw your attention to the chart to the right on page 12, this should look familiar. It's a staple of our market environments where we're showing the performance of major asset classes listed there from top to bottom. The quarterly numbers are the green bars, where the one-year numbers are the dark bars. So we're focused on the quarterly numbers. And if you look at the top three rows, you'll note that it was a pretty flat quarter for U.S. equities. So markets certainly took a breather from the strong run we've seen off the pandemic low back in at the end of Q1 2020. So U.S. equities were pretty much flat, slight negative return. They did outperform international developed equities. You can see below that at negative 0.4%. So international developed markets, places like Europe, the UK, Japan, and Australia. But where the real action to the downside, you can see is emerging market equities below that were down a little bit more than 8%. And that was really due to some issues in China. Namely, there's been a crackdown on some of the, from a regulatory perspective, on some of the largest companies there, and some concerns over a couple of large property developers that have become very over-leveraged, and the Chinese property market has slowed. So some concerns around a potential default and then the ramifications of that to the broader Chinese economy. So Chinese equities were under pressure, and a lot of other emerging market equities traded down in sympathy with that. But why that's relevant for the pension fund is there's a 6% target allocation in the current IPS to emerging market equities, but we've been running an underweight to emerging market equities for quite some time. As I'll show you in a little bit, it was about 4.5% versus the 6% target. So that was a tailwind for a relative perspective, being underweight the worst performing equity region. If you look below emerging market equities, you see U.S. bonds there. You see a slight positive return. Anytime bond returns are flat, it really just means interest rates didn't do much during the quarter. They moved up ever so slightly for some intermediate term maturities, but obviously bonds pay quarterly income, so the income more than offset that slight price pressure from an uptick in yields. Right below that, high yield bonds were actually the best performing traditional asset class during the quarter, up almost a percentage point. And again, why that's relevant for the pension fund is that most of the active managers have some allocation to high yield bonds. Now, they do have most of their assets in more conservative areas, but that small allocation was a tailwind for them as well, since high yield bonds, as you can see, outperformed investment grade U.S. bonds above. The last thing I'll mention on this page before we get into the results themselves, if you look further towards the bottom where you see commodities, they were actually the best performing asset class, up about 6.6%. So they started out the quarter relatively slow and really ramped up towards the end of the quarter. And as you know, why that's important right now for the fund, the current IPS calls for a 4% allocation to commodities. We don't have one because we're moving in the direction where we're decreasing the alternatives, increasing exposure to traditional assets like equities and fixed income. But at least for the third quarter, not having any allocation was a little bit of a headwind, since, as you can see, commodities were the best performing asset class. So with all that said, if you can now please hop behind Exhibit 3. So grab that tab, flip it over, and we will start on page 19 with some high-level observations for the fund itself before getting into some of the data. So you can see at the top of page 19 under observations, we ended the quarter at $133.1 million, so I do have an updated market value to share with you later on in the meeting. During the third quarter, there was an investment loss of $600,000, and you can see below that, that translated to a portfolio return of down 0.4% versus that benchmark of down 0.2%. Now, importantly, like we've talked about in the past, those private market investments in real estate, in private equity, and in private credit are on a lag, so we don't have the 9/30 values yet. So we fully expect once those values to come in, and I'll illustrate this shortly when I show you the revised second quarter return, that ultimately that negative 0.4% return will be revised upwards, as we saw in Q2 and Q1. So with that said, just a couple of quick notes on these next bullet points where you see attribution. That really is just explaining the difference between how the fund did relative to that policy index return. So on the positive side, what helped that first bullet point, a couple of the active managers. The first one is the small cap manager within U.S. equities did quite well. Even though it was a challenging environment, mostly more high quality defensive type stocks did well in small caps. And Virtus KAR, that's an abbreviation for Kayne Anderson, that's the area they focus on, high quality, more defensive areas. So the market environment was really tailor made for their strategy. Below that, as I noted, emerging market equities, the underweight to that asset class, since it was the worst performing segment, not having as much money as the target allocation calls for. That was helpful. And then below that, outperformance by Millennium, the one remaining active or one remaining hedge fund. You know, there are still two, but they're being liquidated over time. But Millennium did quite well relative to the benchmark. And then again, as I mentioned, outperformance by the active fixed income managers. Now, on the negative side, this is largely asset allocation driven. Again, like we've talked about, you know, the underweight to alternatives, overweight to more traditional areas like equities. But since U.S. equities and non-U.S. equities were a little bit negative, having more money in those areas was a little bit of a headwind. And that underweight, as we've talked about before, is really, or that overweight, excuse me, is sourced from the hedge fund underweight and the commodities underweight. So right now, the current IPS calls for 12% in hedge funds, where we only have 4%, and hedge funds were up a little bit less than 1%. And I showed you the commodities return shortly. So that slight difference in return was really driven by that asset allocation. And then as far as the looking ahead items, we'll tackle those in the next book once we wrap up the quarterly report. On page 20, just at a high level, as far as the cash flows, the returns, and some of the asset allocation, you can see at the top table the summary of cash flows for the third quarter all the way to the left there. We began at about $132.9 million. We did see positive cash flow during the quarter to the tune of about $813,000. And then you see the net investment loss below that. So even though there was a net investment loss, the cash coming into the fund more than offset that. So all told, the fund grew by about $237,000 or so during the quarter. Now, I'll talk more about the returns here in the middle of the page shortly when we look at those peer rankings as we do each quarter. So the last thing I'd like to note on this page is the bottom asset allocation versus the targets, again, for the existing IPS, and really all the way to the right there on page 20, the differences. So you can see in those first three rows, those are the equity markets in aggregate. We're overweight to the tune of about, we'll call it $9 million in equities, and that overweight is really sourced from a couple lines down, the hedge funds. Again, there's a 12% target right now. We're only at 4%, and that's where we're headed. So again, we have more money in traditional assets because that's the direction we're heading, and that overweight to those traditional assets really sourced from the alternatives, namely the hedge funds. So with all that said, if you would please hop to page 27, we'll get into the results themselves. And like we always do, I'm really going to speak to page 27 and then to page 28, which is a restatement of the Q2 results now that we have the private market investment values. And then I'll circle back to the quarterly number, the Q3 number, just to give you some sense of what the revision could look like. So again, this is a peer ranking page. We use a third-party platform to generate these reports. There's probably trillions of dollars of institutional assets on the platform, so it gives us a good opportunity to slice and dice the data, compare it on an anonymized basis to see how the fund is performing relative to its peers. So there's a lot going on this page, but if you could focus on the two lines below where you see the circle and the triangle, and then we'll work our way from left to right. So there again, you'll see the negative 0.4% return for the fund and the negative 0.2% for the benchmark. The numbers in parentheses are the rank. So here, lower numbers are better, higher numbers are worse versus the median. So we were in pretty much the third quartile. But again, I'm going to circle back to that in just a minute after we look at the next page. Year to date, which now includes the restated values for Q2, you can see the return of 10.6%. And that was good for top 14% relative to the universe and slightly ahead of the benchmark. So certainly a strong start, excuse me, to 2021 as a whole. And I think we can really attribute that to a number of things. If you recall earlier this year, really trying to decrease fees, get out of some of those more retail-oriented strategies. We took a hard look at equities and fixed income to mitigate some of those tilts and bets, take a more balanced approach, and I think that's evident in the year-to-date numbers there. And then as you work your way from left to right, more on the short-term time horizons, 1, 3, 5 years, strong numbers, mostly relative to the benchmark, relative to peers. But as you know, the 10-year number, sort of the flip side to that, but again, the changes that we've been making so far this year, and as we head into 2022, very hopeful, very confident that we will continue the recent success that we've had. If I can draw your attention to page 28 now, this is important really for two reasons. Number one, again, we have the restated values, and number two, these are the fiscal year numbers. So again, it's the same sort of analysis, but just for the previous quarter. If you look at those bottom two rows where you see the circle and the triangle and then work your way from left to right, you can see that the second quarter return came in at 5.9%. That was originally 4.6% when we sat here, I believe, in August and delivered these results. So it was revised upward to the tune of about 1.3 percentage points. The original ranking was in the 83rd percentile, and now it's in the top quintile. So again, just illustrative of when we get those values, because of the size of the fund they are and the diversification they provide, they can have a big impact once we get them. So just quickly thinking about that and circling back up to page 27 in that quarterly number. So we had a 1.3 percentage point upward revision in Q2. It was similar in Q1. If we're conservative and say, well, maybe we get less than half of that, which I think is very conservative, of just 50 basis points, then all of a sudden we're back up in the top quartile. So just illustrative of the fact that since they're a large portion, it's important not to read too much into the quarterly numbers. It's really the more short, intermediate, and long-term numbers that are going to tell you the full story until we get those revisions. So the last thing I would like to note on page 28, under the one-year column, obviously that's the fiscal year number, we have all the finalized values there. So the return, you can see 29.1%, good for the top 18% in this universe. So that's great, right? But why is it mostly important? Because it's almost 4 times the assumed rate of return of 7.25%. So we, all else equal, which it never is, as far as the rest of the assumptions within, that Bolton is assuming and how the actual experience plays out relative to those assumptions will have some impact. But this really has the biggest impact over the health of the fund. But it's important to recognize that there's a smoothing effect, right? Bolton smooths these assets over a 5-year period. So even though we're about 20-ish percentage points ahead of that bogey for the year, they're only going to recognize 20% of that in the next valuation. And then each of the 4 subsequent years, the rest of that in 20% increments. So think about that as it'll have positive implications, but it'll also have some money in the bank, if you will, right? Because if the next fiscal year doesn't turn out as well as this one, and odds are that it won't, given how strong it was, we'll still be recognizing those gains over the next 5 years, and it gives us some cushion in case markets aren't as generous as they were this year. But all that said, it's nice to celebrate a very strong return for the fiscal year.
That's great.
And will obviously have positive implications for the health of the fund, the funded ratio, and obviously from a budgetary perspective for the county. Let me pause quickly there for any questions from the board at this time. I just want to make some other quick comments as it relates to the fees and the new data that the board asked us to show before moving on. But again, let me pause quickly.
Are there any questions from board members?
No questions from Sean Moses. No questions here either, thank you.
And I'm good, thank you.
Good, thank you.
Okay, great. So if you would all please flip to page 37. We'll spend a little bit of time talking about the fees, and again, just illustrate what we've added here per the board's request at our last meeting. So again, if you look at 37 to the left, those are all of the investment managers within the fund. To the right of that is the fee schedule. Then you see the percentage of the portfolio, and obviously those 2 columns multiplied will give you the estimated annual dollar amount, and then on a percentage basis. So a couple quick things to note here. About 5 rows down from the top all the way on the left, and again this is on page 37, you'll see the William Blair Small Cap Value Fund. So if you recall earlier this year, we had made a recommendation for the board to consider the ICM Small Cap Value Fund. They were acquired by William Blair at that time, which we spoke about in the middle of the year. But importantly, what William Blair has done, and excuse me, let me back up for a second. It's the same team, the same process, the same strategy. They're just now under the William Blair umbrella. But what William Blair has done is offered a new share class called an R6 share class, which is really the cheapest share class amongst mutual funds, where previously there was just an institutional share class. So the institutional share class was valued at 89 basis points. That was the fee. So once the R6 came out, I worked with Ms. Pratson to submit instructions to Wells Fargo just to make the conversion to the new share class. Again, same team, same process, same holdings, but now at a fee at just 80 basis points versus 89, so a reduction of about 10%. So like hopefully we've shown throughout the year, we are very diligent about that to ensure that all of the funds within the portfolio are in the lowest cost share classes. And we were fortunate enough to have the opportunity to make that conversion this year. The other thing I'd like to draw your attention to, it's about, let me do a quick count, 1, 2, 3, 4, 5 rows below that, where you see Blackstone Real Estate Income Fund at about 1.25% of assets. Earlier this year, we spoke about how Blackstone made the decision just based off how the fund was, or the assets that comprised the fund, to essentially unwind it and return all the capital to shareholders. That's almost fully done now.
Right.
Okay, there's just a nominal amount, I believe, of about $20,000, $30,000 left within the fund. It was around $1 million this year. So as they've unwound that, obviously with a fee of 1.25%, just with that organic unwinding, that's helped marginally with the fee. And the last thing on this page I'll mention, if you recall, we made the recommendation to terminate one of the hedge funds, the Graham Absolute Return Fund. That was, the paperwork was submitted in either June or July. Forgive me, I don't recall the exact date, but those funds were returned during the third quarter. It was about $3.5 million. The fee was about 1.5%. So that is gone, and those proceeds were rebalanced within the fund. So that's also helped on the margin. And you can see the impact of all of that in the middle of page 38, where you see the blue line all the way to the left where it says investment management fee, and then work your way all the way to the right. At the end of the third quarter, we ended at 55 basis points. So to be frank, that's still a little higher than I would like, but we're moving in the right direction. At the end of the second quarter, that was 58 basis points. So a reduction of 5 to 6% from a total dollar perspective. So we are headed in the right direction there. And as I'll explain when we hit the next discussion materials book in just a couple of minutes here, maybe some further opportunities to whittle that down even further. However, before getting there and wrapping up, if I can draw your attention to where it says additional fees towards the latter third of page 38, this is the new data that the board requested. So in the description all the way to the left, you can see the investment consultant fee, obviously us, and the custody fee, obviously via Wells Fargo. So I will talk about the first one, Marquette Associates. As you work your way all the way to the right, you can see the estimated annual fee in dollar terms. This is for the SORP only. As you believe all well know, we have a flat fee with the county across 3 funds, and the fee is prorated based on the assets. So obviously the fees will change marginally based on the relative, difference in the market values, but assuming and hopefully that the market value grows over time, since it's a flat fee, then that will come down over time.
Right.
And then beneath that, even though Wells Fargo is on an asset-based fee of 3 basis points, you can see all the way to the right. Again, as you all well know, we're undergoing the custody RFP, which we'll talk a little bit more about shortly. And as I have discussed previously, I fully expect, given the competition with that custody RFP, that we're also going to see some marginal improvement with those fees as well. So I wanted to bring those to your attention since they were requested by the board at the last meeting. And then all the way at the bottom again, you can see the estimated annual fee, which is inclusive of the investment managers, ourselves, the custody, and then all the way to the right as a percentage, 0.67 of the total SORP fund. So with all that said, that wraps up my comments for the performance report. But again, please let me pause here for any questions or comments from the board.
Thank you. And I would like to express my appreciation on page 38 for adding that information in. So appreciate that, and you drawing our attention to it.
Absolutely.
Are there any other questions or comments from the board?
No questions or comments from Clay Safford. Thank you. None from me. Thank you.
And I'm good too. Thank you.
Okay, great.
Great. So that wraps up, that discussion. So the next book starts with 3B, with the investment policy statement. So this would be for those of you following on board docs, the document titled discussion materials. And also there's a separate document titled investment policy statement _ SORP. So the next couple of items will be addressing both of those documents that are on board docs.
Thank you. And just to pause for a minute, Pat, that's 3B for us in board docs for the investment policy statement update. So just for those folks listening, they can follow along.
All right, great. Thank you, Dr. Bridget. So before we jump into the policy statement and the discussion materials, if you could flip over that cover and then flip over that title page there again, we'll have the policy statement first. We'll get into some recommendations and just wrap up with some next steps, talking about things that we're thinking about, things that we'll be bringing to the board's attention as we head into the new year of 2022, which is crazy to say that we're almost there, but important to set the roadmap as we head into the new year. So for the investment policy statement, if you flip over that first exhibit, you will find the document itself in the hard copy. So just as a quick review, at our last meeting, we showed the proposed revisions to this document, all of which were approved. This is the clean version of the document. So really, unless there are any questions or comments, anything further to what we've already discussed, it would be our recommendation that the board would formally approve the policy statement and really make it effective as of January 1st, 2022, just to have a clean break with the new calendar year. So again, with all that said, please, I'll pause here for any questions or comments from the board as it relates to this document.
Thank you very much. I think the document looks really good. It was well put together and it took a lot of work. So again, appreciate your efforts on that. And I appreciate Lieutenant Moses' suggestion to put the watch list selection and criteria back in the document. So much appreciated for all the hard work by the board members as well as by Marquette. Are there any other comments or questions on the investment policy statement?
No, I appreciate all the changes also. A lot of work did go into this in the time, but and all your explanations. So thank you very much.
You're welcome. I mean, obviously, it's a very important document and, you know, needs to be done thoughtfully and deliberately, and I feel like it's exactly what the board did. So I'm happy where we ended up.
Thank you. Anything, Lieutenant Moses or Lieutenant Safford?
Nothing here. I think it looks good, and thank you. Yeah, same from me, Pat. Thanks for all your hard work in getting this done. And, you know, this is the document that guides us and keeps us on track. I think the revision history speaks for the deliberate intent that we all had in making it the most refined policy statement we can, and I appreciate it. It looks good. And Dr. Bridget, I don't know, I think we were intent on signing it today if we approve it. I guess we could leave it at Ms. Pratton's office and come through for signature.
Yes, she'll coordinate signature for us. That would work great. There is a motion to accept the investment policy statement, and we may want to add that its effective date is January 1, so that we can add that to the document.
All right, I'll go ahead and make the motion. I move to approve the investment policy statement as presented by Marquette Associates and authorize the members to sign the document and have it effective January 1, 2022.
Thank you very much. We have a motion on the floor. Is there a second?
Sean Moses will second.
Thank you. We have a motion and a second. Any discussion? Hearing none. All those in favor?
Aye.
Aye.
Any opposed? Motion carries. Thank you all very much, and thanks again, Pat. And then item 3B is for rebalancing recommendations. Pat?
All right, great. Thank you, Dr. Bridget. So this will be found behind Exhibit 2. And you'll note there are two different fund allocation iterations, if you will, one on page 5 and one on page 6. And I thought it would be instructive not only to show how the fund lined up versus the current IPS, but how it would look relative to the new IPS, because I think some of the rebalancing recommendations are intended to help slowly move us in that new direction. So I'll just make one quick comment here on page, or excuse me, two quick comments here on page 5. In the third column to the right, all the way up at the top where you see total assets, this is about, as of a week ago, the fund was at $137.7 million, so that's up about $1.5 million since we last met just 3 weeks ago. Markets have been fairly strong, and also we've begun to get some of the 930 private market investment values as well. So wanted to point that out. The last thing on page 5, again, if I could draw your attention to the bottom left box, that smaller box. As you know, this is where we sort of summarize the asset allocation, the respective overweights and underweights that are found in the right-hand column where you see difference. So as you all well know, we have more money in equities, notably in the U.S. and developed non-U.S., a slight underweight to emerging markets. You know, we had to stay within that plus or minus 9 percentage points per the current IPS, and that was really sourced from the alternatives bucket. So where things stand as it relates to the new policy is on page 6, and I'd like to walk through this now and in addition provide some color around the recommendations. So if I can draw your attention to the bottom left-hand box again, and I apologize it's so small, but there are a lot of investment managers and hopefully it is readable. But now look at the differences here. Again, I think it's illustrative of, we've been managing things where we were headed. So with the total equities now, instead of being 7% or 8% overweight, it's almost in line at about 1.5 percentage points. As far as the private markets, that's a combination of a private equity and private credit. We're a little bit overweight there. I'm going to circle back to that in just a minute. And then as far as the rest of the asset classes, hedge funds, just pretty much in line with the target. Real assets or inflation-sensitive assets a little overweight, but where the big underweight now is within fixed income. Now, before getting to the rebalancing recommendation and, again, moving us slowly towards the new target, I want to make a quick comment as it relates to the private markets. We spoke about this probably in January or February. There was one private credit investment called the Blackstone Secured Lending Fund. It was a closed-end investment, and I alerted the board that it was Blackstone's intention essentially to have an IPO or have that fund listed on an exchange, making it tradable and therefore giving us liquidity. Right. So we expect that to happen in short order. So when that does, and I'm going to confirm the details with Wells Fargo and Morgan Stanley to make sure we can act as appropriate when the time comes. I'm hoping that time comes in January and have a recommendation for the board at that time. I think it'll allow us to mitigate that overweight and get things more in line with the private market. So I just wanted to bring that to your attention. I think that's something that we'll be hopefully discussing in January. So with that said, if I can draw your attention to the rebalancing column in the middle of the page, and all of the proposals are really towards the bottom third. Again, as I mentioned, the real assets or inflation-sensitive bucket has a material overweight. So the recommendation here is to make some partial redemptions. Number one, from Cohen & Steers, the Global Listed Infrastructure Fund. If you notice right to the left of the $500,000, that fund's about 3.7% of the total fund. There is a private infrastructure fund also at 0.7%. So we're about 4.5% in infrastructure with a target of 4%. So we're trying to mitigate that overweight to some degree, and it's a similar story with real estate. If you can see the next redemption proposal, $2.25 million from the Fidelity Real Estate Index Fund, because, again, if you look to the left of that number, it comprises almost about 4% of the portfolio. The private real estate investment's almost 2% versus a target of 4%. So that's even further overweight than the infrastructure bucket. So that will allow us, again, those, even though they're real assets, they're equities, right? And we already have a slight overweight to equities. So I think it kind of makes sense to, when we look at that real estate or real assets bucket, that's really where the liquidity is, to source that to mitigate some of that fixed income overweight where you see that below. So some of those funds will go into the Delaware Diversified Income Fund, $1.25 million. $500,000 in the Lord Abbett Short Duration Income Fund, and then $1 million you can see in cash. And I'd like to make two other quick comments for the board for further context. So Ms. Pratton recently brought to my attention, we talked about the drop payments scheduled for next year. So there's a drop payment estimate on January 1st, I think around $600,000 or so. April 1st, it was about double that. I think about $1.3 million, and then we had a smaller one on June 1st. But recently, the participant that was going to draw that money in June has chosen to draw it in on January 1st. So we, in aggregate, we're looking at a little bit more than $2 million in cash needs by June. Now we're looking at it by April 1st, which is just a little more than 4 months away. So at a time when markets have been really good, and we know we need that cash. From a risk management perspective, let's just make sure we have it in the bank and we're not meeting in January and February and March and saying, oh, we have to sell something at the wrong time.
Right.
So I think it would be prudent, again, to raise that cash since we're going to need a lot of it in short order. And the other quick thing I'd like to mention, the money going into fixed income here, you see nothing going into the Loomis Sales Bond Fund. So that fund is a little different than the other two funds there. And what I say by different is it has a wide range of asset classes that it can invest in that aren't all fixed income related. It can invest in preferred stock, convertibles, has some equity exposure. It made sense given the current fixed income benchmark, which included a lot of exposure to high yield bonds, to corporate bonds and things of that nature, which are more aggressive. But as we move to the new benchmark, which is all investment grade bonds, which is more conservative, then I think it would be appropriate for us to consider, and I'll give a little bit more color to this in just a second, to maybe replace that fund with something a little bit more conservative that might provide us a little bit more ballast in the environment that equities aren't doing well, where that fund in particular would probably take it on the chin relative to the other fixed income options. So with all that said, you can see the impact to the right in the right table box lower there, pretty much just the changes. You see the real assets overweight, so third up from the bottom, green, just going to about percentage point overweight. Fixed income, that underweight mitigated slightly, and then cash increasing as well because we're raising cash. Now, importantly, the real assets overweight is really coming from tips. So that is obviously fixed income, but it's an inflation protector. So the underweight to fixed income isn't as drastic as it seems because we have more cash relative to target, and the real assets bucket or overweight is comprised of fixed income, but fixed income that does well during periods of inflation.
Right.
So with all that said, I wanted to provide that context, and then on page 7, as we typically do, we just spell out the recommended or proposed board actions as outlined on the previous page 6. This would be adding $500,000 to the Lord Abbett Short Duration Income Fund coming from Cohen and Steers, $1.25 million going into the Delaware Diversified Income Fund, which is much more conservative than the Loomis Fund, and then $1 million from cash, and those two additions coming from the $2.25 million redemption from the Fidelity Real Estate Index Fund. So with all that said, with that context, let me pause here for any questions or comments from the board.
Thank you very much. Any questions or comments from the board members?
I have one. Can you hear me?
Yes.
Yeah, this is Clay Safford. It's more, not a question, but more just like an observation that I just noticed here. It seems like the planning when it comes to the drop money for participants when their drop date comes, that we're putting a lot of thought to it, as we should, on how to move our money around in order to pay for the drops. But I just think it's important that we all remember that these members have an option to get out of the drop on the 11th hour prior to the 3rd year, which when you talked about that earlier about the moving the money around, just something to keep in mind that can happen, and that we're moving the money around just because of up to that last point before the 3rd year hits. Do you understand?
Yes, I think that's a good point. We'll have to be cautious about that.
If I could just make a quick comment to that, and Ms. Pratton, please correct me if I'm wrong. I believe the drop payouts that I've just spoken to are all of the ones that are at least projected right now for 2022.
Correct.
So for what it's worth, I think that's also important context to Lieutenant Safford's comments a second ago.
Mm-hmm.
Good. Thank you very much. Any other comments? Hearing none, we'll entertain a motion to approve the proposed rebalancing.
I'll make a motion to approve the proposed rebalancing recommendations presented by Marquette and Associates.
We have a motion on the floor. Do we have a second?
I'll second it. Clay Safford.
Thank you, Lieutenant Safford. We have a motion and a second to approve the proposed rebalancing. Any comments? Any discussion? Hearing none. All those in favor?
Aye.
Aye.
Any opposed? Motion carries. Thank you very much, and thank you. We appreciate it. We're going to jump right into old business, which is Millennium Distribution. Catherine?
And Dr. Bridget, may I just ask if we could have a motion to accept the third quarter performance report?
Oh, yes. Thank you. We were rolling right through. Thank you. We're going to go back to 3A. That's the third quarter investment performance report. We did not take a motion to accept or approve the report. So with that, we'll please entertain a motion for that.
John Moses here. I'll move to approve the third quarter investment performance report presented by Marquette Associates.
Thank you, Lieutenant Moses. Do we have a second?
I'll second.
I'll second it.
Thank you. We have a second. Any discussion? All those in favor?
Aye.
Aye.
Any opposed? Motion carries.
And Dr. Bridget, before we move forward, did you want to go over the next steps?
Just quickly, if it would please the board, I didn't see it on the agenda, right? But it is in the book. If that's
sure, that's fine.
Just a quick minute.
Thank you for all your help today. I appreciate it. Keeps us all on track.
Zooming along.
I know we are zooming. Yes, very much. Sorry about that, Pat. Thank you, Jeanette. I appreciate it.
No worries. So just quickly on page 9, and this is in the same discussion materials book. I just want to again sort of set the stage for our upcoming discussions, particularly the next meeting. And I spoke to this a second ago as it relates to fixed income. But again, if you recall, in our earlier meetings, we took a really deep dive into the equity investments and the fixed income investments. Again, where are we, having tilts away from the benchmark, where are the bets, and trying to mitigate them and take a more balanced approach. So that was within the context of the old investment policy statement. So once the new one will be in effect, we're going to do another review, as you can see on page 9 under U.S. equity. You can see that current benchmark for U.S. equities is comprised of 3 different indices. The first one is large caps, the S&P, and then you see 15% of the Russell 2500, that's small and mid caps, and then 12% of small caps. And not terribly sure the reasoning behind that construction. We're big believers that the benchmark should reflect the broad market. So the new benchmark is the Russell 3000, which is the broad market encompassing large, mid, and small caps. So with that said, again, circling back to my comments earlier, I think there's going to be opportunities given that new benchmark to maybe reduce some of the allocation to the active managers in the small cap space, maybe incorporate or use more of those passive funds to get more in line with where the market is, and hopefully some marginal reduction in fees. And then a similar story under fixed income. Again, you can see the current benchmark there that is constituted by a wide range of different fixed income benchmarks, with the latter two, you can see to the right there, high yield, and the last one, world investment grade. There's a lot of credit risk embedded in those indices, and again, having that Loomis fund made sense given that. But now we're moving to this new benchmark, which is comprised of just investment grade bonds within the U.S. I think warrants, again, a review of the fixed income with a possible, and I'll say likely, quick manager search for potential replacement of Loomis that might be a little bit more conservative and a little cheaper, again, because we want that fixed income to provide protection and provide ballast for the rest of the portfolio. So that's what I plan to tackle in the next meeting in January. And then subsequent to that, I won't walk through all of these items here, but did want to just quickly mention the second to last bullet point there, custody RFP updates. The deadline is tomorrow for responses. I personally talked to 4 of the larger banks that operate with institutions like yourselves in the Mid-Atlantic area, including the incumbent. So we expect to receive, hopefully, at least 4 responses tomorrow. And then we'll get to work from there as far as the scoring and the rest of the procedure through that. And then, as I mentioned, hopefully competition breeds lower costs and lower prices. And we'll continue to report back to the board on the progress of that exercise.
Great. Thank you very much.
Thank you.
And if I may just jump in as well, I just received today an update from Wells about the transition to principal. So they are still targeting February 22nd.
Okay.
So that's still a good date. So with all of the custody work, we're keeping that transition in mind as well, because we have to be sensitive to all of those dates.
Good. Thank you very much. Any questions or comments for Pat? Okay, Jeanette, was there anything else?
I think that's it.
Okay, good, great, thank you. Anything else for us, Pat?
No, thank you all.
All right, thank you, and have a nice Thanksgiving.
You do the same. Thank you.
Thank you. And item 4 is old business. We'll jump into 4A for Millennium Distribution Conversion Request. Catherine?
Thank you, Dr. Bridget. And this is really a follow-up from the last meeting where the board approved purchasing the alternative shares or the different share class with the Millennium Redemption. And attached to the documents that we have, as well as loaded in board docs, is the form that was reviewed by legal and approved, and then signed and submitted by Pat.
Great, thank you. And thank you to our county attorney's office for our support on that document. Thank you.
And Millennium did confirm receipt of that, and so far has not let me know that anything is out of order, so I assume we're good to go.
Good.
And do you know the timing on that, when we would see that, or?
Well, the conversion would take place at the end of the year. That's when they would make the distribution. So we'll see. Again, you won't really see any difference because you have the 2 share classes and they report on the aggregate amount. But at this time next year, they're going to have another distribution. So we'll have the same conversation in October of next year.
Good. Okay, great. Thank you.
You're welcome.
Good. Thank you. Any other questions? Hearing none, we move to item 5 for public comments. Do we have any public comments today?
And Dr. Bridget, I wanted to add there's no administrator report because we had no expenses.
Wow. Okay.
First time ever.
I think so.
Thank you for that announcement. That should have been an agenda item.
Well, Tracy and I were wondering if we should go back and add it as an agenda item, but I don't think it's ever happened before.
I know. That's great. Congratulations. That's great. And item 6 is adjournment. If there's nothing further from the board members, we'll entertain a motion to adjourn.
I'll motion to adjourn.
Do we have a second?
John Moses will second.
Thank you, Lieutenant Moses. And for the second, we have a motion and a second to adjourn. All in favor?
Aye.
Aye.
Any opposed? Motion carries. Thank you all very much. Have a nice Thanksgiving.
Thank you.